Welcome back to the deep dive. When we talk about economics, yeah, most people's minds jump straight to money, banking, stocks, budgets. The sexy side, maybe?
It definitely is the sexy side, but it's also kind of the narrow side. If you zoom out a bit, economics is really fundamentally the study of human behavior, specifically how we behave when things are limited.
Right, constraints. It's a way to understand choices when resources could be time, money, even just like your attention span are scarce.
Exactly. And that framework lets you analyze, well, all sorts of decisions. It's not just finance.
Yeah, like why do people pile their plates higher at a pricier buffet compared to a cheaper one? Or how does a homeowner decide if mowing the lawn this weekend is worth the gas and the hassle versus, putting it off?
And those decisions, they aren't totally random. They often follow some pretty reliable foundational ideas. Maybe we should lay out a few key ones.
Good idea. Let's set the stage.
Okay, first principle. People face trade-offs. Simple idea, but huge. Every single choice means giving up something else. Always. Because you can't have everything.
The classic example, right? A parent choosing, do I work overtime, get more income, or do I spend that afternoon with my kid? There's a clear trade-off. The money versus that, irreplaceable family time.
Which leads directly to the second big one. Honestly, maybe the most important concept in all of economics. Opportunity cost.
Okay.
The real cost of choosing something isn't just what you pay for it in dollars. It's the value of the next best thing you had to give up, what you sacrificed.
Right. So if I spend an hour listening to us talk economics, the cost isn't just like my internet connections, the hour of sleep I missed, or maybe the workout I skipped. The value of that sleep or workout is the actual cost.
You got it. And that flows naturally into number 3, thinking at the margin.
Ah, the margin.
Yeah. Traditional people don't usually make all or nothing decisions like, should I study 0 hours for this exam or study for 24 hours straight? No. We think incrementally.
Bit by bit.
Exactly. Should I study 1 more hour? Should I eat 1 more slice of pizza? We take an action only if that extra benefit, the marginal benefit, is greater than the extra cost, the marginal cost.
And here's the kicker, right? It's the relative size that counts, not necessarily how big the numbers are overall.
Absolutely. You could be looking at a massive project, say a $100 million factory. Huge cost. But you only greenlight it if you expect the additional revenue to be, $100 million on $1. Just that tiny bit more.
It's all about that incremental edge. Fascinating. Okay, so let's take these ideas, trade-offs, opportunity cost, marginal thinking, and apply them to the firm, the basic unit of business.
Right. And the firm has, at its core, a pretty clear goal. Maximize economic profit.
Which sounds simple. Total revenue minus total cost. But you said economic profit, and that word cost, that's where it gets tricky, isn't it?
It really is.
Yeah.
Because most people, and even basic accounting sometimes, focus on explicit costs.
The obvious stuff.
Yeah, the money that actually leaves your hand. Things you get a receipt for. For a pizza place, that's the flour, the cheese, the rent on the shop, the electricity bill, the wages you pay your drivers.
Straightforward, cash outlays. But the economist digs deeper. What are we missing?
We're missing the implicit costs. These are the opportunity costs that don't involve a direct cash payment. They're invisible, almost.
Okay, give me an example. Like the pizza oven.
Perfect example. Let's say you sink $50,000 of your savings into buying this amazing state-of-the-art pizza oven. The explicit cost is, well, $50,000. You paid that.
Yep.
But what else could you have done with that $50,000? Maybe you could have put it in a savings account earning, say, 5% interest. That's $2,500 a year you're not earning. That foregone interest. That's an implicit cost of owning the oven.
Ah, I see. So the economic cost of the oven is the purchase price plus the interest you gave up. And the really big implicit cost is usually the owner's time.
Often, yes. If you quit a $80,000 a year job as, say, an engineer to open this pizza place, that $80,000 salary you sacrificed is a real cost to your business. Even though no check is written for it, it's an opportunity cost.
Okay, this makes economic profit way more meaningful than just looking at the accounting books. So wait, if a business owner tells me they're making 0 economic profit, should I feel sorry for them?
No, definitely not. You should congratulate them.
Really? 0 sounds bad.
0 economic profit is actually the goal, in a way. It means they've earned enough revenue to cover all the explicit costs, the flour, the rent, everything, and they've fully compensated themselves for the opportunity cost of their time and their invested capital.
So they're doing just as well running the pizza shop as they would have in their next best alternative, like that engineering job.
Exactly. They're covering all costs, seen and unseen. They shouldn't shut down. They're doing fine in the economic sense. It's a sustainable position.
That's a critical distinction. Okay, understanding costs is key. Now, how do these costs behave when that pizza place actually starts making pizzas? Let's talk about the short run.
Right. So in the short run, some things are fixed. Your capital, think the physical size of your kitchen, the number of pizza ovens you have.
Yeah.
You can't just snap your fingers and change that overnight. It's fixed.
Okay.
So if you want to change your output, make more or fewer pizzas. The only way to do it in the short run is by changing your variable input, which is usually labor. You hire more staff or you send staff home.
Right, you can adjust hours or people easily, but building an extension takes time.
Precisely. And this fixed capital constraint leads to a really important concept, diminishing marginal product.
Okay, sounds technical. Break it down with the pizza oven.
Sure. You have one oven, fixed capital.
Yeah.
You hire your first worker.
Right.
Wow. Production jumps. Pizza's flying out the door.
Right.
Hire a second worker. Still really good, maybe almost as much increase. But then you hire a third, a fourth. By the time you get to the 8th or 9th, worker crammed into that same kitchen using that same single oven. Well, what happens?
They start getting in each other's way, waiting for the oven, bumping elbows.
Yeah, exactly. They're sharing limited counter space, maybe waiting for tools. The additional output you get from hiring that 9th worker is much, much smaller than the boost you got from the first or second worker. They become individually less productive at the margin.
And this isn't because they're bad workers, it's just too many cooks for the kitchen size.
Precisely. It's the fixed capital constraint biting. And this directly impacts your costs.
How so?
Well, think about it. If you're paying every worker the same wage, say $20 an hour, but that second worker added 15 pizzas in their hour, while the 9th worker only added 2 pizzas.
Ah, the labor cost per pizza for those last 2 pizzas is way higher.
Exactly. The cost of producing just one more unit that's the marginal cost starts to rise. And it can rise really steeply as production increases. It's a direct reflection of that diminishing marginal product.
Okay, understanding these cost curves, how costs change with output, that sets us up to look at how firms behave in different types of markets. Let's start with the textbook ideal, perfect competition.
Right. Perfect competition. Think lots and lots of small buyers and sellers. The products are basically identical, or at least buyers see them that way, like basic agricultural goods, corn maybe, or different gas stations selling the same grade of gasoline. And crucially, anyone can jump into the market. No real barriers to entry.
So loads of sellers, identical stuff, easy entry. What does that mean for the individual firm, like one small dairy farmer?
It means they're a price taker.
Mm.
The market sets the price. If milk is selling for $6 a gallon today, that single farmer can't just decide to charge $7. Nobody would buy it. They have to accept the $6 price.
They have no power over the price, so their only decision is how much milk to produce at that $6 price.
Exactly. And the rule for maximizing their profit is pretty clear. Produce the quantity where the marginal revenue, the extra revenue from selling one more gallon, which in this case is just the $6 price, equals the marginal cost.
Yeah.
The extra cost of producing that last gallon. Find where MRMMC.
Okay, produce where MRMC to make the most profit. But what if things go bad? The market price crashes maybe below their cost. Are they losing money? When do they, just give up and shut down?
Yes, the short run shutdown rule. This tricks people up. A firm might actually keep operating even if its total profit is negative, even if it's losing money overall.
Why on earth would they do that? Keep operating while losing money?
Because of fixed costs. Think about the rent on the barn, the insurance payments, maybe loan payments on the milking machines. Those costs have to be paid in the short run, whether they produce 0 gallons or 1,000 gallons. They're sunk.
Okay, so those fixed costs are unavoidable in the short run.
Right. So the decision becomes, if I operate, can I earn enough revenue to cover my variable costs?
Yeah.
The feed for the cows, the electricity for milking, the workers' wages for that day, and have anything left over, even a tiny bit, to put towards those fixed costs I have to pay anyway.
So if the price they get for milk, $6, is higher than their average variable cost, ABC, the per gallon cost of just the variable inputs they should keep milking.
Precisely. As long as price ADC, they are covering their immediate operating costs and contributing something towards the fixed costs. Shutting down would mean they still pay all the fixed costs but get 0 revenue, so operating minimizes their loss.
But if the price drops below the minimum point of their ADC curve?
Then they hit the shutdown point. Now, every gallon they produce costs them more in variable inputs than they get back in revenue. They're losing money on the variable costs, plus still having to pay the fixed costs. At that point, it's better to stop production immediately and just absorb the fixed costs, minimize the damage.
That makes sense. It's counterintuitive but logical. Okay, so that's perfect competition. Price takers, no barriers. What's the polar opposite?
That'd be monopoly. One single seller. Think maybe your local water company or historically companies with strong patents. The key is high barriers to entry. It's really hard or impossible for anyone else to compete.
So they don't take the price, they make the price. They're price setters.
Exactly. They still want to maximize profit, and they still use the MRMC rule to decide how much to produce. But here's the crucial difference. For a monopolist, the marginal revenue they get from selling one more unit is always less than the price they charge.
Wait, why is MR less than price for them?
Because they face the entire market demand curve, which slopes downward. To sell one more unit, they have to lower the price not just for that extra unit, but for all the units they were already selling. So the gain from the extra sale is offset by the loss on the previous unit.
Okay, so MR is below the demand curve, which represents price, and they produce where MRMC. What does this lead to?
It leads them to naturally restrict the quantity they produce compared to what would happen in a competitive market. They hold back output to keep the price higher.
That's good for their profits, obviously. But what about, well, us, society?
That's where the problem lies. This restriction of quantity, while perfectly rational for the monopolist maximizing its own profit, leads to a societal inefficiency called deadweight loss.
Deadweight loss. Okay, what is that exactly?
It represents value that is lost to everybody. It's the potential gains from trades that don't happen because the monopolist restricts output. There are consumers out there who would value the good more than it costs the monopolist to make it, but they can't buy it because the price is too high and the quantity too low. The economic pie is literally smaller than it could be.
So even if the monopoly isn't doing anything illegal, just maximizing profit, their existence creates this loss for society, this shrinkage of the pie.
That's right. It's a market failure caused by the market structure itself.
Okay, so we've got perfect competition on one end, monopoly on the other. What about the middle ground where there are just a few big players?
Now we're entering the world of oligopoly. A few dominant firms. Think airlines, maybe mobile phone carriers, car manufacturers in some markets.
And here things get strategic.
Absolutely. It stops being just about calculating your own costs and becomes a game. Your best move depends entirely on what you think your rivals are going to do. This is the realm of game theory.
Game theory. Players, strategies, payoffs.
Exactly. And the classic problem in oligopoly is the temptation versus the danger of collusion.
Collusion meaning they try to act together like a monopoly.
Precisely. Imagine just two firms, a duopoly. So they're the only two companies that control for water in a town. They could agree, maybe secretly, to restrict how much water they both pump.
Why would they do that?
To keep the price high. If they both restrict output, the price stays up, and they could potentially maximize their joint profits. Maybe they each make, say, $1,800 profit if they cooperate. That's the best outcome for them together.
Okay, sounds good for them. But is there a catch?
Always. The catch is the individual incentive to cheat on the agreement. Let's say firm A honors the deal and restricts its water output. What's firm B tempted to do?
If firm A is holding back, firm B could secretly pump a bit more water.
Exactly. They grab a slightly larger market share. Since the price is still high, because firm A is cooperating, firm B's individual profit shoots up maybe to $2,000. But firm A, who's stuck to the deal, sees their sales fall and their profit drops maybe to $1,500.
So cheating benefits the cheater, but hurts the partner and the overall agreement.
Right. And of course, firm A knows this. They know firm B is tempted to cheat. So firm A is also tempted to cheat preemptively. The logical outcome is often that the collusion falls apart.
Yeah.
The agreement is inherently unstable.
It contains the seeds of its own destruction because of self-interest.
Perfectly put. And this whole situation is a classic example of the prisoner's dilemma.
The famous game theory scenario. Remind us how that works.
Okay, two partners in crime are arrested and interrogated separately. They can't communicate. The police offer each one a deal.
Right.
If both stay silent, cooperate with each other, they both get a short sentence, maybe 1 year. That's the best joint outcome.
Okay.
But if you confess and implicate your partner, cheat, and your partner stays silent, you walk free, your partner gets hammered with, say, 20 years.
Oh, shit.
If you both confess, you both get a medium sentence, maybe 8 years.
So what should you do, thinking only about yourself?
Well, think it through. If your partner stays silent, what's your best move? Confess. You go from 1 year to AWO years.
Okay.
Now, what if your partner confesses? What's your best move then? Confess again. You go from 20 years down to 8 years.
So no matter what your partner does, your individual best strategy is always to confess.
That's the dominant strategy. And since both prisoners think this way, the predictable outcome, the Nash equilibrium, is that they both confess and they both end up with 8 years, which is way worse for both of them than if they had trusted each other and stayed silent.
Individual rationality leads to a collectively bad outcome. That's fascinating. So this failure to cooperate, this cheating, it's bad for the prisoners, and it's bad for the duopolists whose profits collapse when their price war starts.
Yes, it's bad for the players involved in the game.
Yeah.
But, and this is a huge point from the perspective of society as a whole, this difficulty that firms have in colluding, it's generally a good thing.
How so?
Because when oligopolists compete instead of colluding, what happens? They produce more output, the price comes down closer to the competitive level, and that deadweight loss we talked about with monopoly shrinks or even disappears. Consumers benefit from lower prices and more availability.
So the inherent instability of collusion actually protects consumers, in a way.
It often does. Self-interest, ironically, can lead to better social outcomes here.
Yeah.
There was actually a weird real-world example with cigarette advertising.
Oh, yeah.
When the U.S. government banned cigarette ads on TV back in the 70s, you'd think it would hurt the tobacco companies, right?
Seems likely. Less advertising reach.
But their profits actually went up significantly afterwards.
How did that happen?
They were stuck in their own prisoner's dilemma, an advertising arms race. If Marlboro advertised heavily, Camel had to advertise heavily just to maintain market share. These huge advertising budgets basically canceled each other out and just ate into profits.
Ah, so they were both spending millions, but neither was gaining much advantage over the other.
Exactly. The government ban unintentionally forced them both into the don't advertise box of the game, the cooperative outcome they couldn't reach on their own. It effectively solved their prisoner's dilemma for them, boosting their joint profits.
Wow, that's a brilliant, if slightly perverse, example of game theory in action. Okay, let's pull back from the individual firm and market games. We've done a lot on microeconomics, individual choices, firm behavior. How does this connect to the big picture, to macroeconomics?
A key bridge concept here, especially thinking long-term, is monetary neutrality.
Monetary neutrality.
It's the idea that, in the long run, changes in the money supply, which is a nominal variable, just numbers on paper or screens, don't actually affect the real variables in the economy.
What are the real variables?
Things like real GDP, the actual quantity of goods and services produced, the unemployment rate, real wages, what your paycheck can actually buy, the physical stuff, the actual economic activity.
So it's like the Monopoly board game analogy. If the banker just prints twice as much Monopoly money and gives it out, you don't suddenly have twice as many houses or hotels on the board. The game itself, the real assets, haven't changed, just the prices.
That's a great analogy.
Yeah.
In the long run, doubling the money supply basically just doubles the price level. It causes inflation, but it doesn't make the country fundamentally richer in terms of real output or jobs.
Now, you said in the long run. Does it have effects in the short run?
Yes. In the short run, things can be stickier. An injection of money might temporarily boost demand, maybe tricking firms into hiring a few more workers because they see more dollars coming in before they realize costs are rising too. But eventually the adjustments happen and the real variables tend to return to their long-run levels. The neutrality holds over time.
Okay. But what happens if a government doesn't just adjust the money supply modestly, but relies heavily on printing money to pay its bills?
That's where you get into serious danger. That's effectively using the inflation tax.
Inflation tax? How is inflation a tax?
It's a tax on holding money. When the government prints excessive amounts of money, it devalues the currency that everyone is already holding. The cash in your wallet, the money in your checking account, buys less and less. It's like the government is stealing purchasing power from its citizens without passing any legislation.
And the extreme example of this, we saw it in Zimbabwe, right?
Oh, absolutely. Leading up to 2008, Zimbabwe experienced hyperinflation on a scale that's almost impossible to comprehend.
I remember seeing pictures of banknotes with insane denominations.
They were printing bills for 100 trillion Zimbabwean dollars, and inflation rates. The estimates vary, but some suggest it reached peaks like 800 billion%.
Per month.
Billion% per month. That's mind-boggling. Prices changing by the hour.
Or faster. And did all that money printing make Zimbabwe richer? Did it build factories, improve farms, create real jobs?
Clearly not. It just destroyed the economy.
Exactly. It wiped out savings, made rational planning impossible, and shattered the ability to conduct even basic trade because nobody trusted the currency. It's the ultimate painful illustration of monetary neutrality. You can print money, but you cannot print real wealth.
A harsh but vital lesson. We started this whole deep dive by saying economics is about human behavior, often measured using money because, well, it's measurable. I think Alfred Marshall, one of the founders of modern economics, had something to say about that.
He did. He acknowledged that economists often focus on motives measured by money because it's the steadiest motive to ordinary business work. It gives the field rigor. But he added a caution, didn't he?
Yes. He said that when we define normal action in economics, we shouldn't ignore powerful non-monetary forces,
Yeah.
like ethical considerations, or his example was family affections, if those forces are regular and predictable drivers of behavior.
Which brings us to a final thought, perhaps. We've seen how market structures, from perfect competition to oligopoly, are largely shaped by firms rationally pursuing profit, pursuing that self-interest measured in money.
hmm
So the provocative question for you, the listener, might be this. If those powerful, regular, but non-money-based motives, things like altruism, ethics, loyalty, are truly part of normal action, how well can our economic models really capture the business world if we struggle to measure and integrate these forces alongside profit?
That's definitely something to chew on. We hope exploring these core economic ideas helps you see the choices around you and the choices you make in a slightly different light. We'll catch you on the next deep dive.